moving on to some of the really basic issues that relate to the reporting of intangible assets. We don't go significantly in depth on intangible assets. They are their own section of the balance sheet. And we cover this in depth in later accounting classes, but we're going to expose you to some of the basics related to them. Intangible assets are rights, privileges, and competitive advantages that result from ownership of long-lived assets that do not actually have a physical substance. You can't actually touch them. Some well-known intangibles are patents of Microsoft, franchises of McDonald's, the trade name iPod, Nike's trademark swoosh. Intangibles can be evidenced by contracts, licenses, and other documents, and they can arise from a variety of sources, such as government grants, the acquisition of another business, or contractual agreements. Common types of intangible assets are patents, copyrights, franchises, licenses, trademarks, trade names, goodwill, and they may have limited or indefinite life. Intangible assets are recorded at cost and are categorized as having one of those two types of lives. The cost of intangible assets with indefinite lives are not amortized, whereas those that have limited life are amortized. The process of allocating to expense the cost of intangibles is referred to as amortization. To record amortization of an intangible asset, the amortization expense is increased or debited, and the specific intangible asset itself is decreased or credited. Unlike depreciation, we don't use a contra account. We actually go to the actual asset. Typically, intangible assets are amortized on a straight line basis. So, for example, the legal life of a patent is 20 years. It should be amortized over its 20-year life or its useful life, whichever is shorter. In determining the useful life, a company would consider things such as obsolescence, inadequacy, and other factors that might cause a patent or other intangible to become economically ineffective before the end of its legal life. Some types of intangibles that you might encounter. Patents. Patents are an exclusive right issued by the U.S. Patent Office that enables a recipient to manufacture, sell, or otherwise control an invention for a period of 20 years from the date of the grant. The initial cost of a patent is the cash or the cash equivalent price paid to acquire the patent. If there are any legal costs involved in successfully defending a patent in an infringement suit, those are added to the patent count and amortized over the remaining life of the patent. Research and development costs that lead up to a patent are expenditures that may create the new process, the new product, but there's great uncertainty in our research and development process, including the identifying the extent and timing of the future benefit of those expenditures. Therefore, those are recorded as an expense when they're incurred. How we treat research and development costs, so treating them as expenses at the point in which they occur, is a little bit contentious. Some accountants would argue that this results in understated assets, that the value of the patent is actually higher than that of what it actually costs. So we're talking about the filing of the patent, that type of stuff, not the R&D to get the product created. Whereas others are going to argue that if we were to capitalize all of our R&D costs, it creates assets on the balance sheet that may or may not contribute to cash flows in the future. So they're speculative. So let's just look at National Labs, who purchased a patent with a cost of $60,000 on June 30th. They estimate that the useful life of this patent is going to be 8 years. So the journal entry to record the amortization for the 6-month period ended December 31st. Remember, we use straight line for most amortization. It has a $60,000 cost and an 8-year useful life. That gives us annual expense of $7,500. We're dealing with 6 out of 12 months for this first year. So we have amortization expense of $3,750. We'll post that directly to the patent itself and reduce the value on the balance sheet directly. Research and development costs that are expensed when incurred are those expenditures that can lead to patents, copyrights, new processes, new products, any of those things. They're not intangible costs because there's no guarantee when we're in research and development that it's actually going to result in a marketable good, in a marketable artistic work, in an actual new process, in an actual new product. Somebody else may beat us to it. So we may not be able to patent whatever it is that we were working on. Copyrights are granted by the federal government, and they give owners exclusive rights to reproduce and sell artistic or published work. These are granted for the life of the creator plus 70 years. The cost of the copyright consists of the cost of acquiring it and defending it if necessary. And the useful life of a copyright generally is deemed to be significantly shorter than its legal life. We amortize to expense over that useful life. Sometimes the acquisition of a copyright can be very, very expensive. So for example, Michael Jackson paid millions of dollars for the copyrights to the Beatles music. However, the cost of a copyright for created work could just be $10 fee paid to the U.S. Copyright Office. It's going to depend upon how you have to go about acquiring it. If you created it, you are the creator. It can be very economical, $10. If you are buying something that has been created by somebody else, that's when we go into a whole different valuation system. The next intangible that we'll talk about is trademarks and trade names. A trademark or trade name is a word, a phrase, a jingle, a symbol that really distinguishes or identifies a particular enterprise or product. Trade names like Wheaties, Monopoly, Sunkist, Kleenex, Coca-Cola, Big Mac, and Jeep create an immediate product identification and generally enhance the sale of the product. The creator or the original user may obtain an exclusive legal right to the trademark or trade name by registering it with the U.S. Patent Office. The registration will provide 20 years protection, and it can be renewed indefinitely. If a company purchases the trademark or trade name, the cost is the purchase price that they paid to the original owner. If the company develops the trademark or trade name itself, the cost would include their attorney's fees, their registration fees, design costs, any successful legal defense costs, and other expenditures that are directly related to securing it. Because trademarks and trade names have indefinite lives, they are not amortized. Franchises are something that we are all exposed to almost on a daily basis, and we may not even realize it. As consumers, we are always engaging in business with franchises. A franchise is a contractual agreement under which the franchisor grants the franchisee the right to sell certain products, to provide services, use certain trademarks or trade names, usually within a designated geographical area. Another type of franchise, granted by government body, permits the business to use public property in performing its services. So the use of airwaves for radio and TV broadcasts. Such operating rights are referred to as licenses. When costs can be identified with the acquisition of the franchise or the license, an intangible asset should be recognized. Annual payments made underneath a franchise agreement should be recorded as operating expenses in the period in which they're incurred. In the case of a limited life, the cost of the franchise or the license should be amortized as an operating expense over its useful life. If the life is indefinite or perpetual, then the cost is not amortized. Next, we have what's called goodwill. Goodwill is an intangible that often confuses a lot of students. Goodwill only exists when, as an organization, you purchase another organization. And it is the excess of the purchase price over the fair market value of the identifiable net assets that were acquired. So if your net assets fair market value is $10,000 and you pay $100,000 for the organization, it has $90,000 of goodwill. This is a representation of the value of all the favorable attributes that relate to that company you're purchasing. This could include exceptional management, desirable location, good customer relations, skilled employees, high quality products. It is very unique because unlike other assets like investments and plant assets and some of the other intangibles, which can actually be sold in marketplaces, goodwill is only identified with the business as a whole. It's recorded when we go through that exchange transaction of a purchase of an entire business. Goodwill is not amortized because it's deemed to have an indefinite life. However, it can and must be written down if there is a determination that the value of the goodwill has been permanently impaired. So let's look a little bit more at some of the classification concepts. Here we have 3 issues, and we have 5 terms. Which of these terms applies to which of these issues? I want you to press pause and identify the correct ones, and then I want you to press play again and see if you are correct. Now that we've gone through the first 3, there are 2 more issues. Press pause and identify the term that is most directly associated with that statement. Then I want you to press play and see if you're right. If you were wrong on any of these 5, go back and review the information, because these are the basic issues related to intangible assets that you should be familiar with.